Okay, Assalamualaikum, Doctor. So firstly, I'm going to explain about the introduction. So the Great Depression was a global economic depression that began in 1929 and lasted until 1939. Okay, it was the world's longest and most severe downturn, causing profound changes in economic institutions, macroeconomic policy, and economic theory. So it resulted in sharp losses in output, unemployment, and severe deflations in practically every country have to face it. And in the US, industrial production decreased 47%, GDP fell to 30%, and unemployment reached more than 20%. Following the Great Depression, the global financial crisis, or GFC, was a period of high stress in global financial markets and banking institutions that lasted from 2007 to early 2009. Then the COVID-19. So the epidemic emphasizes the need for health and economic policy action, particularly global cooperation to mitigate its effects, protect vulnerable populations, and build countries' capacity to prevent and respond to similar crises in the future. Emerging market and development economies are especially vulnerable and should strengthen public health system, address issues posed by informality and weak safety nets, and undertake reforms that will generate strong, sustained growth once the crisis has passed. So, if the pandemic's effects linger, emerging countries and developing economies will, with fiscal space and reasonable financing, may seek to additional stimulus. So next, this should be supported by steps to restore medium-term fiscal sustainability, such as strength in fiscal frameworks, increasing domestic revenue mobilizations and expenditure efficiency, and increasing fiscal and debt transparency. So that's all from me for the introduction.
Hi, my name is Atira. So I will talk about the type of multiplier in pre and post GFC policy multiplier. So the enhanced framework contains three additional variables compared to the planned priority model, which is the first one is central bank balance sheets asset holding relative to GDP. The second one is the real interest rate, and the third one is the debt to GDP ratio. As doctor can see in the slide, the method that we use, which is the data and estimation approach, and at the panel A, Federal Reserve balance sheets, we estimate the model using US quarterly data for 1966 until 2019. The central bank asset are the Federal Reserve asset holding at the end of each quarter. The real interest rate is the 10 years bond yield less the inflation rate. The latter measure using the GDP deflator. The debt to GDP ratio is the outstanding debt of the general government, which is the federal and state divided by nominal GDP. The growth rates of the three series are shown separately in figure 1 against the growth rate in real GDP per capita. Panels A to C. So the variable changed significantly after the start of the financial crisis in 2007, especially government debt accumulation and asset purchase by the Federal Reserve in terms of level. Note shown, the debt ratio increased from 63% at the end of 2007 to approximately 107% by the end of 2019. while Federal Reserve asset holding increased from 6 to 19% of GDP over the same period. So this is the what we call the graph that I was talk about. So our prayer is that these significant movements have had a lasting negative effect on the strength of key policy multipliers. The result of our analysis support the view. To estimate the CVAR, we first estimate an unconstrained VAR in level with a single leg of the 5 endogenous variable, which is real revenue per capita, real expenditures per capita, real GDP per capita, Federal Reserve balance sheet assets, and the real interest rate. And the last one is the debt to GDP ratio as in the figure 1. So the lead length was chosen using the subword information 3 trillion. So lastly, it remain identified with this long run constraint imposed and is non-linear by construction, and estimation was carried out using the method of maximum likelihood. Okay, next is under pre and post GFC policy multipliers in the result, which is multiplier pre and post GFC. So we now consider various policy adjustment scenario and discuss the response of real GDP per capita to the shock. For each shock, we use two data set to measure the sensitivity of real per capita. And then the objective is to assess whether there has been a change in the corresponding multipliers in the crisis, and thus to draw conclusion on the efficiency of macro policy choice per and post crisis. So we also compare the pre and post behavior of real GDP following a shock to the debt ratio. We assume without loss of generality that the shock occurred in 2006 for the pre-crisis model and in 2018 for the post-crisis model, and we trace the response of real GDP per capita for 8 quarters after the shock. Although the initial shock are 12 years, which is 48 quarters apart and different in absolute value, and the separate response of GDP per capita are comparable because in both cases the shock is a unit percentage change, and we express the corresponding response in real GDP per capita as the percentage change relative to the baseline. Okay, so as can see in the slide, where this is the first scenario involve a percentage point increase in the debt ratio. So figure 2 shows the percentage change in real GDP per capita relative to the baseline for the post-crisis and pre-crisis period. Following the shock to the debt ratio, real GDP decreased initially both pre and post-crisis, with the negative effect being slightly larger per crisis. After 2 periods, the impact of higher debt or real GDP is still negative but declining towards zero, and the negative impact is larger in absolute terms post-crisis compared to pre-crisis. And the negative impact is larger. Initially, the large initial negative impact may be due to negative expectations. So lastly, note that the US debt level reached 107% by March 2020, and it may be approaching or reach level where debt has a negative effect on real growth. As of July 2021, the debt level was slightly above 130%. That's all from me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. I'm Afifah Naswa Abbas, metric number 278536. I will be talking about the fiscal multipliers during pandemic. The fiscal multipliers calculate the effect of an increase in the fiscal spending on the country's gross domestic product (GDP). Fiscal multipliers are generally understood by economists to be the ratio of changes in output to change in tax received or government spending. Fiscal multipliers are crucial because they can direct a government's action during a financial crisis and pave the way for a subsequent economic recovery. There are studies on fiscal multipliers from Outpers, which relies on a non-linear empirical model to show that the fiscal multipliers is larger during recession or periods of economic weakness. This study also emphasized that the fiscal multiplier tends to be larger when interest rates approach the lower bound of zero or when monetary policy covers government spending. Fiscal multipliers tend to be low in countries with a weak fiscal position. One reason behind this evidence is the interest rate channel fiscal expenditure at an already high level of debt or low fiscal credibility can further increase the the credit risk and borrowing costs across the economy. This also limits a country's potential to fight a pandemic. Fiscal multipliers are greater in the years right after the start of a health crisis. When a pandemic occurs, multipliers are noticeably bigger than in non-pandemic states. 1 year following the pandemic shock, the cumulative multiplier in advanced countries increased to approximately 1 compared to about 0.4 in the non-pandemic era.
Assalamualaikum and good day. My name is Zulaika binti Zulhishan Sharil and my matric number is 278857. I'm going to proceed our group presentation with the next part, which is policy implications. I'm going to explain policy response to Great Depression, which will be include two policies. The first one is the fiscal response. The depression happened for a variety of reasons. Market speculation by both private investors and banks had artificially inflated the value of many stocks traded on Wall Street, and to make matters worse, banks had utilized huge sums of consumer deposits as capital to trade openly on the market. The Great Recession was an economic slowdown that began in the United States, which lasted from late 2007 to mid-2009, was the longest and most severe economic slump in many countries, including United States, since the Great Depression. It was the longest and most severe economic collapse since the Great Depression. In February 2008, Congress and the Bush administration passed the Economic Stimulus Act, which cut tax from low and middle-income people while offering tax breaks to promote business investment. It was intended to stop the recession by temporarily boosting consumer spending, but it was not enough to reverse the rising crisis and had no long-term consequences. The new administration's fiscal policy was driven by many concepts. First, the fiscal effort had to be undertaken as soon as possible. Second, considering the extent of the economic challenge, it should be broad. Finally, it should be a persistent effort that not only provides immediate economic stimulus over the first 2 years, but also provides continuous assistance after that. The new strategy would need a combination of policy tools such as cut tax and other temporary aid that place money in the hands of those that need it right away. Next is the monetary response. The Federal Reserve employed two main techniques to forward guidance, which offered an indication of its intention for the future cost of short-term interest rates and asset purchases, also known as quantitative easing. Both of these measures help to lower long-term interest rates across a wide range of maturities. The Federal Reserve achieved this goal through forward guidance by changing the market's expectation of the future cost of short-term interest rates. The asset purchases also had the impact of decreasing long-term interest rates and raising aggregate demands by enhancing the market value of corporate debt. That's all from me. Thank you.
Good day, Doctor. I'm Denisa, and I'll be speaking about the policy response to the pandemic. The Federal Reserve established credit supporting facilities under U.S. monetary policy, some of which were backed by CARES Act Treasury funds. They also lowered the cost of existing swap lines with major central banks and extended the maturity of FX operations, increased the number of central banks with access to US dollar swap lines. The Federal Reserve of the United States also provided a temporary repo facility to foreign and international monetary authorities. The commercial paper funding facility is the first facility covered by the CARES Act by Treasury funds. Initially, it was introduced to purchase short-term debt known as commercial paper to keep those market liquid. Later, the types of commercial paper it would purchase were expanded to lower debt pricing. The primary dealer credit facility and money market mutual funds liquidity facility are the second facility. They provided loans to primary dealers backed by various security as collateral under the PDCF, and they provided funds to financial institutions to purchase money market mutual funds under the MMLF. Thirdly, they established the municipal liquidity facility to purchase up to $500 billion in short-term notes. This was only applicable to specific cities and districts that met the certain criteria. The Paycheck Protection Program liquidity facility was then launched to assist small businesses by providing funds to banks, which in turn provided funds to small businesses. The fifth is primary market corporate credit facility and the secondary market corporate credit facility. The PMCCF allowed a corporation to purchase corporate bonds and ensure credit availability, while the SMCCF acquired corporate bonds and bonds exchange trade funds on the secondary market. Aside from that, there is the Term Asset-Backed Security Loan Facility, which makes loans to businesses using asset-backed securities ABS as collateral. Finally, the Main Street Lending Program established an SPV2 by up to $600 billion in small and medium-based business loans. The United States government passed 3 major relief package and 1 supplemented package as part of its fiscal policy. The first stimulus and relief package allotted $8.3 billion to fund vaccine research, give money to state and local governments to fight virus spread, and also to help with efforts to stop virus spreads overseas. They established relief budget under the second one to provide funds to families who rely on free school lunches as a result of widespread school closures, requiring business with fewer than 500 employees to provide paid sick leave for COVID-19 patients, as well as tax credit to assist employers in covering those costs, providing states with nearly $1 billion in additional unemployment insurance funds, as well as loans to states to fund unemployment insurance, and making COVID-19 testing free for all. In terms of nominal dollar amount, the third package is the largest single relief package in US history. This included one-time direct cash payment of $1,200 per person plus $500 for each child, extension of unemployment benefits to furloughed employees, gig workers, and freelancers, and an extra $600 in unemployment per week. And early withdrawal penalties for 400 KS up to 100,000 are waived. Forbearance on mortgages and 180-day moratorium on foreclosure on federally backed mortgages. The government will lend $500 billion to pandemic-affected businesses through the PPP and the expanded Economic Injury Disaster Loan Program. $349 billion in loans and grants were made available to small businesses. State and local governments will receive $150 billion in grants, while schools and universities will receive $375 billion. All of this had a time cut-off. They made program changes under Supplement Package 3.5, such as giving businesses 24 weeks to spend the money, lowering the loan forgiveness requirements, extending the payment deferment period, allowing companies that received PPP loans to postpone paying payroll taxes, allowing business to receive loan forgiveness if they did not rehire workers who refused good faith re-employment offers or were unable to restore operations to pre-COVID-19 levels. It also extended the loan maturity period for PPP loans taken out after June 5th, 2020 to 5 years and gave businesses until the end of 2020 to return pre-crisis payroll levels. It also extended the time for borrowers to repay loan amounts that had been forgiven. During the pandemic, the Fed launched programs to provide backstop funding to a variety of markets, including the corporate bond market, which had previously been excluded from the 13 programs during the financial crisis. Backstop funding for these markets assure investors that the Fed will participate as a last resort, albeit at unappealing prices in normal times. However, having these programs in place ensures that trading occurs in the markets, preventing them from completely freezing up. During the March-April time period, backstop lending programs were successful in containing an impending financial crisis. Financial stress has returned to pre-pandemic levels in January and February 2020. The fiscal package passed during the crisis was significant and far larger than the fiscal package passed in 2009. Personal income increased in the second quarter of 2020, which is the opposite of what happens during a recession, indicating that the fiscal response was successful despite the fact that the US economy experienced its worst contraction on record, with real GDP declining by 3.4% on an annual basis. Personal income rose during the period because the government borrowed money and distributed it to disrupt business and households. While the process has been understandably uneven, the intervention's goals was to get people the compensation they needed to pay bills and maintain their lifestyles during this difficult time. The fiscal policy response was immediate and significant.
So for the conclusion of our case study is we use pre and post GFC policy multiplier to compare the pre and post behavior of real GDP following a shock to the debt ratio. The initial shocks are 12 years apart and different in absolute value, but the separate responses of GDP per capita are comparable. Fiscal multipliers are important because they can direct government's action during a financial crisis and pave the way for a subsequent economic recovery. The United States policy response to the global financial crisis in 2008 to 2009 was characterized by aggressive demand management, short-term stability measurements, and structural changes in health, energy, and also education, technology, and finance. So the fiscal response was successful, with personal income increasing in the second quarter of 2020 despite the worst contraction on a record because of the pandemic. So that's all from our group for our case study. Thank you, Doctor.